had it all at age 28, passive income, financial freedom, the life of my dreams, and then by 31, I was broke. So in this video, I'm gonna go over how I lost everything and what I'd do differently if I could go back in time to do it. Understand, I was a financial advisor. I was teaching people how to invest in the stock market. And so later that next year, when I was 28 years old, I had enough money coming in from real estate that I was able to be retired. Once we got about 2007 going to 2008, the market shifted, it changed. I also got pretty much lazy with my investing, you know? And the next thing you know, I'm in the hole $16,000 a month. Like everything was just falling apart. It was like the perfect storm, but in the George Clooney, I'm gonna die kind of way. Spoiler alert for those of you who haven't watched The Perfect Storm. The good news is my pain becomes everybody else's gain, right? I was really able to reconstruct my plan so that the second time around by 2016, by December 2016 to be exact, I finally got to the point where I had enough passive income, this point at $10,000 a month, to be financially free again. And so I want to talk about what did I really learn? What did I do to dig out of that? And what could I have done to avoid it? Here's what I should have done first and foremost. One, I should not have cashed in my savings. When you start to look at investments and whatnot, especially as a steward, you start to think, hey, I got to get my money working for me. Well, if I have it sitting in a savings account, for example, it's not doing anything. I'm not making much money, which is true, you're not. But that's not the point of savings. The point of savings is to be liquid, to have cash when you need it. Now, can you do better things with it? Yes, you can go get high yield savings accounts that right now might be paying 3 to 4% maybe, you know, depending on what you're looking at. I actually use my infinite banking policies, my whole life insurance policies, because they're paying 6% a year tax-free right now. So I'm storing most of my cash there right now, rather than using the banks where I get taxed on that money and it's paying me less anyways. But I didn't do that back then. I did have an infinite banking policy, but it was a crappy one that ripped me off in fees. And that's why I teach people to do it differently now. I also do this too. I would not put extra money into my house. Understand that during this time, I was a mortgage broker. I still had a mortgage license. I figured if I ever needed cash, simple. I would just go and do a cash out refinance of my property because banks will just give me my money when I need it. Unfortunately, if you know what happened back then, it was starting about the summer of 2007, they started changing the rules very quietly. Nobody really heard much about it until we heard about the fail of like companies like Bear Stearns, right? And then all of a sudden, there's this banking financial crisis meltdown happening worldwide.
They've never seen anything like it.
It means life, as most Americans know it, is about to change.
Well, I started to feel that in 2007 because I went to go do a cash out refinance before that started to happen. And banks would tell me, yeah, you know, Chris, we changed some rules. Just get your credit score up 2 more points and we'll give you the loan next month. And so I did. And then that month they said, yeah, sorry, we're gonna make you wait a little bit longer. And then of course I kept, going back, and by September, they said, sorry, we just don't do cash out refinances anymore. I wish I would have stayed more liquid, not just having savings, but not putting that extra savings also into my house, into my property. The third thing I wish I would have done better is stop focusing on appreciation. I was focusing on trying to make it big. Remember I talked about trying to hit those home runs. I was thinking, listen, if I can just buy a $100,000 property and if it appreciates 10%, I make $10,000. But what if I buy a $500,000 property and that appreciates 10% in the market? Then I make $50,000. So why not just buy bigger properties? So of course, when I went to get a new house, I didn't go for a house that was more comfortable for my family. I got a big house. I got a McMansion. Now at that time, I bought it for just over $600,000. That doesn't sound like much today, in today's money, but back then, that was a lot. And by the way, it did appreciate over the next year because I bought it in 2006. By 2007, it was worth now about $750,000. I thought it was brilliant. I thought it was a genius. But remember, banks started changing the rules. I couldn't get the money out. They changed the rules on everybody else. And so we started watching that depreciate. The problem was this, is that I wasn't focused on cash flow. I was focusing on appreciation. Going back the second time around, what got me out of the rat race is because I focus on passive income, cash flow now. Now, if you don't want to be a knucklehead like I was, and you want to lose a bunch of wealth, but you want to build the wealth and do it the right way the first time around, not have to do it twice, then here's what I recommend. Look into our one-on-one coaching. We actually work with people one-on-one, white glove approach to helping people create a customized game plan to get them out of the rat race as quickly and safely as possible. So if you want to avoid those mistakes but do it better than I did it the first time around and even the second time around, click on the link in the description below to see how we can help you reach that financial independence number right now.